Joining us now for more on the market dynamics is Mark May from Stifel's Global Technology Group. Mark, do you agree with AJ there?
Hey, John, thanks for having me on. I think there is some truth to that. But surprisingly, John, we haven't seen as much take private activity as we would have expected. A lot of those factors that he pointed out have been around for many months now, and we've just not seen as much activity as we would have expected. I do think that things are setting up for a possible acceleration in the back half of the year. If you think about some of the factors that have driven a little less activity, has been, the companies and their boards haven't really reset their expectations on valuation. That takes some time, and we've started to see that happen a bit. We've seen some early signs of that.
And I think what AJ was saying in part was that in the beginning of the year, when the market went back up and maybe things got a little bit more risk on, that's when the deal stopped. But if we get a recession later this year, those boards are going to have to cry uncle.
Yeah, and I agree. I think that there is some truth to that. Now, the reality is that those private equity sponsors like that also like to see profitability themselves or a clear path to. And so some of these companies have underperformed, as he mentioned. A lot of the same reasons why the public markets don't like them sometimes is the same reason private equity doesn't as well. So those companies, also need to get their own, house in shape as well. And we're seeing that through the layoffs. So that's another reason why, activity might start to pick up in the back half.
How does SVB impact all of this, given the fact that it was so active in venture capital and in the tech startup landscape?
I think it impacts a slightly different segment of the universe than maybe we're talking about with the take privates.
Okay.
A lot of those companies are the small and mid cap private technology companies, the companies that I and my colleagues kind of bank at Stifel Technology Investment Banking. And, for them, it could create also an acceleration activity, but of a different sort. One is what we call re-equitization of the balance sheet. So if they can no longer access debt capital like they once did, they may have to raise, equity, and some of their existing investors, they may not want to, reinvest. So we might see a pickup in, equity financing from new investors, and then M&A. We may see a pickup in M&A as well.
Have you seen any of that yet, since you're sort of on the front lines, or have you seen increased business activity in the wake of that bank failing?
So we have seen an increase in activity, but it hasn't been yet that type of activity. These are companies that are just trying to fortify, their lines of credit, making sure that they've got the right treasury, partners in place for payroll and things like that. So that's been, the last couple of weeks have been more of the focus. But we would expect to see an increase in equity fundraising and M&A activity over the next few months as companies, start to realize that they might not be able to access the same type of debt financing on the same terms that they once were able to access.